Welcome back. You're watching Indian Open right here on Bloomberg Quint Live. Yesterday was almost a panic attack for us towards the last half an hour and 1 hour of trade. The indices breached below their crucial levels that we're watching on support levels. But it's really difficult now considering we're the worst performing Asian market.
Yeah, and from the June 3rd peak,
yeah.
Substantially off, way higher than the others. But then, in the plank that was the market support, arguably gave way yesterday, which is the CA's comments.
Yeah, it's as clear as it can get.
Yeah, and very difficult to find solace after that.
Yeah, I probably have to really have some sort of a magic wand to turn this situation around. But for now, taking a look at what the rest of Asia has been doing, Nikkei, Hang Seng, Shanghai, they're all up and about. They're okay for themselves right now, but not the SGX Nifty, which is still trading marginally under 6 odd points, but still in the red. Probably will have some kind of an implication for our open as well. But the other part being the futures and options space, and what came out from there yesterday was the crucial options expiry, weekly expiry. Turnover picked up, but what are the cues indicating for the upcoming week, because that's going to be the monthly expiry. Navneet is joining in for that. Navneet, good morning.
Good morning to both of you. Well, not a great trading session at all in yesterday's trade. You did see more of short positions coming for Bank Nifty, while the volatility also spiked up. But for Nifty futures, which closed at a discount of about 10 points, no major fresh positions were seen. As you can see, the open interest was just about flat. It's the Bank Nifty, and for the week as well, remember, more positions have been added on the short side for Bank Nifty. Futures closed at a discount with markets falling, and open interest went up by as much as 10%. While the markets fell by about 170 points, then that's for Nifty. India Volatility Index also spiked up by about 5%. Now 17 to 18 level is not that comfortable for bulls at all. And even if you look at the options picture now for the next monthly expiry, which is on August 29, the maximum open interest on the call side is at 11,000, and similar is the case for 11,000 put strike. But more positions are now being added on lower level strikes like 10,700 as well as the 10,500 strike. With markets falling yesterday, the put writers also ran for cover. So if you look at the open interest change in yesterday's trade, there was unwinding which came in on the put strikes, and call writing continued for the second straight day in yesterday's session. As you can see on the screen, unwinding for 11,000 put, but on the call side, 11,000, 10,900 and even the 10,800 strikes saw open interest addition. In terms of stock futures, which stood out in terms of OI action, LIC Housing Finance, the stock was down 10%. Fresh shorting was seen there. You had NMDC shorting continues in that counter. Good quality stocks like Bajaj Finance also fell by about 4 to 4.5%, but there was long unwinding seen for that counter. And Dr. Reddy's was up and about in a falling market. There was short covering seen there. On the FI front, they sold on the cash side, but the cues remain just about muted on the index futures side. As we saw for Nifty futures, the open interest was just about flattish. It was the Bank Nifty. So long shorts were added, but still the ratio continues to be on the short side of about 70%. With that, it's back to you guys.
All right, Navneet, thanks very much for that. Now, Amazon and Future Group have finally made it official. The world's largest e-tailer has taken the option to buy, has actually bought into 49% stake in Future Coupons, a promoter company of Future Retail. But what's more interesting is the clause that is put in, which allows Amazon to buy out the entire stake of Kishore Bayani in Future Retail after 3 years. Agam Vakil, he's here to explain this entire structure to us. Agam.
Right, Devina. Well, as you already mentioned, the long-awaited deal is finally here between Future Retail and Amazon, and we have been hearing a lot about this over the last few quarters, and now, well, it's come to fruition. So to start off with the deal itself, as you've already mentioned, about 49% stake that Amazon will buy in Future Coupons, which is a promoter entity for Future Retail. And Future Coupons does not own ordinary shares. It holds warrants, which were issued to the company back in February. But that said, while the Future Retail is buying about 0.5%, nearly half of this particular stake, there will be more in future when it comes to this particular deal. So as a second part, as the first part of course the deal is that Amazon gets voting and non-voting shares, but in the second part there is also a call option available to Amazon, whereby it allows Amazon to buy the remaining stake in future coupons between the 3rd and the 10th year. Of course, a lot of this will be subject to mutual exceptions as well as several applicable laws. But on the whole, this is how the deal looks like, and what is really interesting is that the deal also values future retail at a significant premium.
That's what we wanted to ask you, Agam. How are the valuations stacked up?
Well, actually, this valuations is quite significant. If I tell you 87% to the current market valuation, well, that does certainly seem like a very, very big deal. But according to the numbers that we are playing with, back in February, the deal that Future Coupons and Future Retail had is that Future Retail would issue future coupons, warrants worth 2,000 crores, and it immediately got 500 crores of warrants, which were when the payment was made immediately. The balance 1,500 crores is what Amazon is going to now bring in and pay for the warrants for this particular stake, the 49% stake in future coupons. And that stands at around 3.68% of Future Retail's entire equity. Now, if you equate the 1,500 crores to the 3.68% equity and you extrapolate the market cap, that comes to somewhere around 40,000 crores. But let's not forget that once these warrants get converted into shares, there'll be a little bit of an equity expansion as well. And that's where, based on those calculations, the market cap goes to more than 41,000 crores. Do remember that the current market capitalization for Future Retail stands at less than 21,000 crores. And that's the reason why this particular deal is quite staggering when it comes to valuations given to Future Retail based on just this particular deal.
All right, Agam, thanks very much for that. So that's going to be one stock that's going to be in focus this morning as we open up for trade. But, let's also take a look at what's been happening in the rest of the market. While yesterday's session was a complete washout, the broader market space also saw a lot more pain, considering that the sell-off has already been so stark within the broader market space. But what's been happening today in terms of individual stocks and what you can watch out for, as well as some brokerage calls? I'll start out with you, Amit, first.
So I have the brokerage calls for the day. The first one is on the metal industry, where JP Morgan has upgraded its rating on Coal India and they have downgraded NMDC. Now, for Coal India, they have upgraded their rating because they are saying that the 10% dividend yield is very difficult to ignore and will be a key positive for the stock. Now, for Coal India, they're expecting the volumes to be lower, but the earnings would still increase on the back of lower cost. Now, they have downgraded NMDC on the mine lease renewal overhang, which is the bigger overhang that has been there on the stock, and that's the reason they have downgraded its rating on NMDC to neutral from overweight, and have also cut the target price on the stock to 95 rupees from 145. For Coal India, it's an overweight rating that they have upgraded from neutral and have maintained their target price at 225. Now, they also say that the government sell down, that is an selling of its stake, will continue to remain an overhang on the share prices of both the company. The second one is on Container Corp, where Morgan Stanley has initiated coverage with an overweight rating and a target price of 566. Now, that says that the DFC initiative, that is a dedicated freight corridor initiative, should benefit Container Corp, which is a dominant player in that industry. Now, the railways will gain market share because of this DFC commissioning, and which will also lead to more growth for Container Corp going forward. Now, they're expecting Container Corp's earnings to grow at a 12% CAGR, that is compounded annual growth rate, over FY19 to FY22, and they're saying that the stock is currently trading at a discount of nearly 11% to its long-term valuations. Now, it has a bull case target price of nearly 660, where it is expecting lower haulage charges from Indian Railways, while it also has a bear case target price of 366, where it is expecting delay in DFC.
All right, Amit, thanks very much for that. What are the stocks in news?
Yeah, so a couple of them, Pidilite will be in focus. They've commissioned the second facility in Bangladesh. What they have done is that the management is saying that this move is to further strengthen the adhesive market, the position in the adhesive market in Bangladesh. Capacite Infra has been on a downtrend. They've said that the IC authorities are carrying on search from August 20th on the premises, but they don't see any kind of material impact on the financials because they consider this as routine impact, don't see any kind of impact on the routine operations of the company. BHEL, so one more negative news coming in after the downgrade yesterday. CRISIL has revised the outlook on the long-term bank facilities to a negative from stable. Yesterday, LIC Housing Finance, Goldman Sachs had Fidelity sold in 1.9 crore shares. The acquirer was Goldman Sachs, which bought in 71 lakh shares. And Alchem will be in focus. The Prasid Family Trust sold in 36 lakh shares. Other Aditya Birla Sun Life Mutual Fund and SBI Mutual Fund were the buyers in the block deal.
Okay, thanks a lot for that, Darshan. So watch out for some of these names as well. Now, well, future retail is one thing. Let's see what happens to that stock. I don't know what to do with some of the other names, or what people would advise to doing with some of the other names, like Yes Bank, for example, would be an interesting one to monitor now that it's fallen so much. So there's been about 14% cut coming in for Yes Bank in the last session, but just the 1 month performance of 38 or 39% has been very, very steep. That, and yesterday we saw the biggies and the stable ones come off to Bajaj Finance down about 4.5% odd. Clearly leads one to believe that people are now starting to get concerned about the NPAs on the personal accounts as well, which could happen because of the job losses, because that is something that Prashant Prabhakaran was saying as well, that maybe we'll start seeing that, and that could be a concern.
And Suhas. He said that don't call it NBFC to 3.0, call it retail 1.0, which could be the next pain point and the pain areas for most of the NBFC, there's retail account.
Now, I'm sure these guys will manage it well, but the point being, we haven't seen a situation wherein anybody thought that people will default on the unsecured personal loans, which some of these companies are given. Maybe they won't, but maybe the market will start fearing that they would, and maybe that's why some of these stocks could actually come under pressure.
Yeah, you know what is the other issue is, some of these companies have really, even cyclical in nature, you're supposed to see one cycle where you actually see an uptick. Metals have not seen that in, I think they've just missed the cycle of the upturn, because the pain across the board is so prominent. We're seeing a Tata Steel, we're seeing JSW Steel, everything give way. In the last 1 month, the metals index has been down almost 20-odd%. Tata Steel has been down 28-odd%. These are all big names, obviously heavily leveraged, big debts on the book. And I think probably that is something that is one aspect that the market is clinging onto. Any company with heavy leverage or heavy debt, the environment is such that a question to service the debt arises even for the largest company.
Yeah, but let's wait and watch what happens to some of the metal names. I think if you just look at the past cycles, 2016, 2009, these are the valuations from where they've bounced back. The only argument is, valuations don't quite matter when you are in a scenario which a lot of people fear could be a bear market of sorts, maybe not now, maybe in the times to come, or if we are indeed hitting recessionary notes, if not really a recession period. But lots more to talk about that, and Phil, let's get in our experts on board to try and figure out what to do in a scenario like this. Siddhartha Khemka, Vice President and Head of Research at Motilal Oswal, with us on the show. Siddhartha, good having you. Thanks for joining in. Post the crack yesterday and the commentary that came in from the CEA, would you presume that it's all hands off right now, or are you telling clients to go out and buy into select names?
Yeah, good morning. Pleasure to be on the show. See, it's as you were rightly highlighting, these are difficult times and very difficult to predict how things will move from here. A lot of hopes have been built up in the past few days from the government that they need to come and with some policy intervention or some stimulus package. And yesterday, where the chief economic advisor saying about the market should not expect a stimulus is a dampener, at least for now. But we had our annual investor conference a few days back, where we had the Honorable Minister Piyush Goyal, where he categorically said that the government is definitely looking at a holistic package and is not looking at a knee-jerk reaction to the issues, and that is why it is taking the time that they are taking, and they will come with a whole plan and whole host of things which will be more structural. So the hope is still there. It should come in some way or the other. That is what we understand. Coming to the view, yes, as I said, it's a difficult time, and right now it definitely makes sense to be on the sidelines, wait for things to stabilize. There is no hurry to buy, although valuations for some of the companies have come down from the past, where we were struggling to find comfortable valuations. So as we look at things, earlier the story was good, the valuations were not. Now the valuations are becoming comfortable, but the story is a bit getting distorted. So yes, definitely looking at the current environment, we are on the sidelines. We are waiting for things to stabilize, waiting for that intervention from the government when we can say our customers, our clients to start investing afresh.
Okay. From amongst, I mean, so the market mood is what it is. There are some stocks which are certainly news. And Siddharth, one such name, I don't know if it came up in your conversations in the meetings today, Future Retail, with the deal that Amazon has struck there. Do you guys have this within your coverage?
Yeah. So we recently came out with a detailed report on the entire retail sector. And that is a segment which in this environment has reported good numbers. You can say a kind of oasis in the desert where numbers have been delivered good. In terms of Future Retail, the deal seems to be, so while the pricing and valuations have not been declared, it is on the promoter entity level where the future coupons hold somewhere about 7.3% stake, and Amazon is to take about 49% stake in that promoter level entity. We believe in our discussions, we understand that this could be at a premium to what the coupons, the warrants have been issued to future coupons. So that should be positive, at least to start with. However, effectively this would lead only to a 3.65% stake by Amazon, which to start with is a small stake for Amazon, and definitely they have the right to buy out the other more stake from the promoters, which should lead to further positivity, because what we have seen that Future Retail needs a lot of money there, where they are buying out a lot of these assets from the future enterprises, and for that the promoter needs to provide some of these money through the warrants that they subscribe to. So it definitely leads to some positivity, at least for now, with the Amazon finally managing to cut a deal in Future Retail.
Okay. Shrikant, rather Siddharth, stay on, so much more to talk about. Time now to focus a bit on the charts and the derivative positions as well. Shubham Agarwal, CEO at Quantsapp.com, joins us right now on the show. Good day to have you, Shubham. Thanks for joining in. Post the cuts yesterday and some erasing some of the key support levels. What do you do now today?
Hi, good morning, Neeraj. If we look at the data points now, yesterday the breakdown happened after a large consolidation, and the index is, if you look at the overall movement, there was a 1300 point correction, then a consolidation, and then again the market chooses to actually move down. So I think this overall setup is still negative, and at least 10,600 on the downside is what we would expect, where a temporary bottom might get formed. So for now, I think the strategy should be to avoid any major long, even though there are IT and FMCG is an exception which is continuing to do well. So that both the sectors will be a buy. But other than that, mid-cap banks and if you look at the auto space, these are the sectors which are witnessing heavy shorts even at the current level. So the overall market view is not that positive. 10,600 will be the level to cover shorts and start thinking about going long. But for now, it's an avoid.
Okay. What would be the stock ideas then? I mean, while you do have some of these pockets where you are saying there has been some stability, would you be a buyer in stocks within these pockets, or there's something out of scope that you found?
Yes, so a mixed strategy. So one is on the buy side and the second one is on the sell side. So as I said, that FMCG is a sector which looks positive. And if you look at HUL, despite the fact that the market has been going down, if you look at the data point there, that is largely positive, and it's approaching a new all-time high. So the sector view is also positive, and this has been an outperformer for a very long time. The options data is also positive, where we have seen a lot of unwinding happening gradually, and the derivative data is showing fresh longs that are getting built. So HUL is a buy, but because of the market which is under pressure, I think it would be prudent to actually go ahead and take a trade via options so that the risk remains limited. So 1880 strike call option on HUL can be bought for a target of 25 rupees, and the stop loss can be kept at 8 rupees. And the second idea is a short idea on TVS Motor. And if you look at the stock, despite whatever is happening in auto, even before this sell-off started in the auto space, TVS Motor never performed. So it has been largely an underperformer. And now with the overall sector being beaten down, and on the chart we have a continuation pattern breakdown that we saw yesterday, I think the stock is headed lower for a target of 340, 345. So again, a put option can be bought here. A 350 strike put option can be bought for a target of 14 rupees with a stop loss at 3.5.
All right, Shubham, got that. And any views on future retail?
So future retail, if you look at the overall momentum there, I think not very lucrative, because for the last 4-5 days we have seen a temporary consolidation. But if it is able to hold the level of 418 today, then I think upward breakout might happen. So it's a buy only on a breakout. So above 418 it will be a buy, but unless and until that gets crossed, I think we should avoid it.
Okay, got that. Siddhartha, yes bank and no floor to the selling. What would you do here, and what would you advise for someone who's still holding on?
Yeah, so that has been a very tricky stock to deal with, at least fundamentally, where things doesn't look to stop. While one of the key triggers for the stock was a fund raise, and the company did manage to raise almost about 2,000 crores in a recent QIP at a price of about 83. We thought that should have helped the stock to manage, at least get some floor in terms of stock price movement. However, that is not the case. There are newer issues that have cropped up, the recent being the stake that they have in CG Power, where the company has come out categorically saying that they have there are some issues with regards to the financials that they have been reporting. So it's a tricky stock right now, at least in terms of news flows which are not stopping, while valuations may look whatever they look, because numbers are keep changing every day. It does make sense to wait, at least not look at bottom fishing right now. In terms of people who are already invested holding, they need to keep their nerves. Things do turn around, and it will take time right now, given the amount of issues that they are handling. They are definitely in talks to raise further capital with the PE investors that they were earlier in talks with, and that should be a positive, at least in the long term. Right now, I think the stock would remain under pressure given the news flows that are surrounding the stock.
The interesting part being, the fundraising, if they have to do the second round of fundraising, I mean, the stock's at about 54 right now. The first money that they raised was around 83. They're not going to get the same valuations in terms of raising the money at the same price. So what happens then?
Yeah, I mean, it's a catch-22, and even if they manage to get the money at these rates, the quantum of dilution that happens, for a financial company to do the fundraising at a higher price is probably the be-all and end-all. But yeah, this stock is clearly under, yesterday I used the term spiral for another name, for the markets at large, maybe not, but Yes Bank certainly under a bit of a spiral. The kind of cuts, Shubham, that we saw in some of the stronger names as well yesterday, what do the charts suggest? What do the F&O positions suggest there? HDFC Bank, maybe not so much. It was down maybe a couple of percentage points, but it has lost some value too. Bajaj Finance, Bajaj Finserv, all of these have come off. Are these good short trades?
Neeraj, if I would have to actually go ahead and take a short trade from the banking space, then instead of going with a large cap bank which might rebound if the market starts rebounding, I would want to go actually with the mid cap names, because if you look at some of the stocks like Union Bank, Bank of India, doesn't matter where the market is headed, these are some kind of a perpetual shorting candidate which is consistently making new lows, despite whatever is happening to the overall sector. So even now, my preference will be that, Bank of India, Union Bank and similar stocks can be sold. And in fact, Bank of Baroda is also one of the bet that one can initiate. So these will be a short, and if I have to give it levels, then Bank of India can be sold at the current level. The next target for the stock from a trading perspective would be roughly around 57 rupees, and a stop loss can be maintained at 62 rupees. And Union Bank is also a short with a target of 54 rupees, and a stop loss can be maintained at 60 rupees.
Mm-hmm. Okay. would you then look to invest some in the higher quality banks which have also corrected, like the HDFC Bank and ICICI Bank? ICICI from 420 is now at 400. HDFC Bank has also lost out in the last 2 days. So it looks slightly more attractive considering that these are good quality names.
Yes, Devina, in fact, if I have to, go for a bottom fishing, and if I have to buy two of the banks, the most preferred names for me will be Axis Bank and ICICI Bank. So Axis Bank, the reason being that, if you look at the long-term chart, the long-term charts are still positive, even though there has been a severe cut because of the market. But there are signs that, the bank is now stabilizing, because if you see, Bank Nifty has made a new low, but Axis Bank is holding on to the previous swing lows, and it is indicating that it is now entering a consolidation. So looks like a very lucrative level to go ahead and buy it in portfolio. So 660 is the price right now. One can look for a stop loss at 630 and buy with a medium term target of 760 to 780. And ICICI Bank, the reason to prefer this one will be that we have a model where a quant model where we generally study the nearest relative strength that is happening within the sector. And the rally was actually led by ICICI Bank. And if you look at the chart there, even though it is in a consolidation, the reason I'm saying consolidation is that we saw a swing low around 400 sometime back. And even after the Bank Nifty making a new low, it is still at that swing low. So it is consolidating and available at a very good price. So I think around 400, one should look to invest partially, at least in the portfolio. A stop loss can be maintained at 380 and we would look for a target of 450 to 460.
All right, just a minute left to go for market pre-open. Siddhartha, Khemka, any stock that you find value in that you would like to recommend?
Yeah, so continuing with the retail space, which we have been liking, we have a positive view on some of the mid-size retail companies, including Trent and Future Retail. However, I would like to highlight Aditya Birla Fashion and Retail, which we like in the space, where we have valuation comfort and post Q1 numbers where they have reported strong earnings, both in terms of top line, in terms of margin improvement, and especially the innerwear segment, which has seeing a strong traction in the current market and gaining a lot of share from Page. So overall, we believe this is a good story in the mid-cap space. One should definitely look at a stock in the retail space. We have a target price of 240 there.
All right, 5 seconds left to go for market pre-open, and that's what you've got. A dip of 7 odd points on the SGX Nifty and the pre-open up on your screens. Nifty 50 opens marginally higher, just 3 points, actually flat is what you can say for the index. Sensex though has got gains right now, but we'll come back to that in a bit, taking you through individual stocks and the moves they're about. Grasim is up 1.5%, IndusInd Bank moves up 1%, M&M moves up, Cipla's up 1.4%, NTPC, Infosys, Axis Bank, Bharti Airtel are some of your gainers, but the gains, the quantum of the gains are extremely small. So you just got about 1/3% on Yes Bank, Bharti Airtel 1/3%, nothing much to talk about. But in terms of losses, ONGC is seeing a cut, IOC is seeing another cut, that's about 2.5%. Then you've got Z, which is down 2%. You've got Maruti Suzuki, once at 6,100 from 6,200. SBI is down 0.5%, and Dr. Reddy's too looks slightly weak. Once again, yesterday's session saw us moving very close to that 72 to the dollar mark, and I think today's session we may just actually nudge that. So 71.96 is where the currency is currently trading at. So that too is going to remain in focus. This does not augur well from an equity market standpoint. While it may benefit some sectors, but the overall view for the market stands to remain slightly more muted if the currency starts to weaken further from here.
Yeah. Well, let's wait and watch what happens there. 2 or 3 stocks that cracked big time yesterday. Let's just see what CG Power, Sterlite Tech, and the rest are doing in the session on open. CG Power another 10% lower. Sterlite Tech cracked big time, and another, well, looking like starting off on a weak footing as well. Future Retail, and let's see if on a day like this, after a day like yesterday, do people have the gumption to go out and buy this one? For now, showing an uptick. Let's wait and watch if that lasts. We'll watch out for the bond yields as well. Post the CA comments yesterday. Are the yields cooling off a bit? No, not quite. 6.57 still out there. I think these morning's rates, but flattish. So let's wait and watch what happens. Lots more to talk about really on the macro, and we'll do that a bit later on. But stocks clearly witnessing a punishing downtrend, and the large caps clearly in focus. Just want to mark one last name. Yesterday, we had the metal names cracking. SAIL was at maybe 15-year lows. So let's just see what that stock is up to right now. About 30 rupees, continues to grind lower. Shrikant Chouhan of Kotak with us as well. Shrikant, what do you do with the metal stocks currently? If the stocks have corrected quite viciously thus far, is there more downside that you see?
Good morning. See the way there is a sell-off in all metal companies, and it is like just consistent sell-off that we are witnessing. And yesterday it was like highly unexpected that the Vedanta can fall down by 10%. It was around some 125, 123 levels when it was closing. And the way there is, I think, sell-off, I think now there is a distress selling which is happening, and they are reaching to their 2016 lows. So it shows that there is good amount of distress selling is happening, long liquidation is happening, and now people are exiting out of their deliveries. So if we go through with the metal index, which is down heavily, there we feel that the next level to watch out for is between 1980, 1950. Currently it is around 2200. So that means 10% sort of more sell-off is not ruled out in all metal companies. So what is going to happen is very difficult to say, because in the month of February 2016 and 15, the level was around 1600 for the Nifty metal index. So we are expecting 80% of the entire up move to get retraced, so which is around 1950, 1980 levels. So some more sell-off is not rolled out, but we in the past we saw that whenever there is a such steep sell-off and consistent sell-off, it is better, it is time for those who are like taking positional call on the market or positional stock on any stock, and they should look for adding any one stock to their portfolio, either Vedanta, either Tata Steel, either JSW Steel, where there is hardly any corporate governance. So those stocks one can look for adding with a medium to long term view, because they are just falling and it is completely oversold. So for Steel Authority, I think it is better to stay away, because it's a government based company and it is showing some lower top lower bottom series since 2008. So it is better to stay away from Steel Authority, but certainly one should look for adding Tata Steel or Vedanta to their portfolio.
All right, Shrikant, come back and take your stock recommendations. But a quick word from you, Siddhartha, before we let you go. Would you look at autos now to start picking them up at these lows?
Yeah, so autos have been in the thick of news. They have been the lead indicators of the entire economic slowdown that we are seeing right now. Valuation for some of these stocks have become a bit attractive, and the only hope that currently looks like is any stimulus especially designed for the auto sector that could lead to some short-term up move in these stocks. Apart from that, for a long-term investor, this year looks like, as we have heard from a lot of management, that second half they are staring at a huge double-digit decline in volumes. So it's better to stay away from an investment perspective. There could be downside. We have seen Maruti moving up from about 5,400 to now 6,000 levels. And if there is any positive news flows from the government side, it could move up a little more towards 6,500. However, from the FY20 earnings perspective, it clearly looks bleak to that extent, and one should rather wait for the time correction to happen and then enter.
Siddhartha, we'll let you go on that note. Thank you so very much for joining
Thank you.
Shrikant, coming back to you, let's run through some of your stock recommendations, and post that, if you could actually just go through your stock recommendations, then we'll come back to the next question.
Sure. See, like stock specific, if we go through with the PSU index, then Nifty PSU index is down, and we should look for taking call on those companies which are really down and breaking their 52-week lows or all-time lows. So Bank of Baroda was above the level of 91 since 2015, and this time it is breaking the level of 91. So below 91 we can see the levels of at least 85, 86 in next few days. So it's a short candidate at current levels. So Bank of Baroda to trade short with a stop loss at close to 93.50, 94 levels, and we can expect on the downside 85. The other stock on which we would like to go short is IRB Infra, and there also the formation is not good. It has broken its weekly lowest levels as well as monthly lowest level at 83 levels, and the next level to watch out for is between 75 76. So IRB Infra is also a sale at this price with a stop loss at 83.50 on the high side.
Okay. Shubham, Coal India, uncharted territory, lifetime lows. What do you do?
And in fact, Devina, it's also a PSU which generally doesn't give a lot of confidence. So maybe that might be an added factor. But coming back to the charts, very clearly the stock has never made any returns for the investors. If you look at the movement from 2014 till date, there has not been any term in between where it might have given a positive return. So I think this broad consolidation from 2014 till date, where the level of 210 was holding on, now even that is breached, so that would invite all the portfolios to get squared off, and I think that's what is leading to this severe sell-off where the prices are falling dramatically, and this can continue for a target of 150. So people have bought, it's a heavily owned stock, and gradually those portfolios will get liquidated. So I think even at the current level it is a sell. So any pullback happens, maybe 185, 190 would be a good level to re-enter for a short trade. 200 can be kept as a stop loss, and 150 is the level that I would expect, at least in the short term, as the nearest target.
Quick thoughts from Deven, Choksey as well, Johnson on the conversation. Deven, good having you. Thanks for joining in. The high quality financial names are now starting to give way, Deven. Do you think that will continue more? What do you do with HDFC Bank, Bajaj Finance, Bajaj Finserv?
Good morning, Neeraj. This is a state of capitulation, as I have been mentioning, and I think in which you have nothing to spare. When you incur losses in one part of the portfolio, I think to fulfill those losses good, you end up selling the jewels from your portfolio, and that's what is currently happening. Unfortunately, I think the process of loss making activity is continuing for such a long period of time. It's dragging actually on the market. And if you see, I think the biggest victims of this particular process are the companies which are not necessarily fundamentally weak companies. They are rather, I think some of them are good quality companies in the mid-cap space. But unfortunately, I think for the reasons I think of liquidating and generating cash in the portfolio, the fund managers are compelled to sell some of the good quality stocks, and as a result of which I think it results into collateral damages onto some of the large names I think which you mentioned just now. I think it's time that we do something into the system. Not necessarily that I think all these companies are bad, as I said. Maybe I think some amount of support buying is required in the system into some of the mid-cap companies. If that doesn't happen, then probably to me I think it will damage further this entire situation. So I think we'll have to wait and see, but I don't see I think fundamentally things going that wrong. Unfortunately, I think our market sentiments are going extremely weak at this point of time.
Deven, one stock that you've liked in the past is facing some serious stress is Sterlite Technologies, down 19% yesterday. I mean, it's lost 75% of its market cap. What happens here now? I mean, and why is this happening in the first place?
Yes, I think it's important to establish the problem first and then probably look at I think how the situation can be looked at. The problem statement out here is that initially I think the problem started with the pledge of shares by the promoters, and pledge of shares I think happened because of their requirement to fulfill their obligations somewhere in the other part of the world. Now after having removed the pledge, I think the another things which has started is that I think they've been they've been expressing their interest to buy out I think companies like Jet Airways or for that matter Arcom. I don't think that investors are very happy with this kind of a process, because on one side I think you show your appetite to buy out those companies, on the other side I think it results into a significant amount of I think leveraging in the group, and that's where I think people are not very happy. So this is the reason for which I think in last few days we have seen the stock getting hammered, And to me, I think this hammering has happened. I do not know, I think, which part of the investors who have sold these shares, because I think that's not something which I am privy to. But I believe that I think some of the institutional investors, I think, who bought this particular stock on the story that the growth is basically going to be smarter, I think they have been selling it off. Fundamentally, even though I think the spot prices of fiber optics and cables are relatively low, I think this company has long-term contracts where they are basically commanding the premium prices, and that visibility is available for next 2 years for this company. So I don't think that fundamentally things are going wrong. Maybe I think people are now reading too much about, I think, the spot prices of fiber and relating that price to, I think, every category of fiber, whereas I think this company is manufacturing fiber for some of the specialized category where they're commanding the premium. Unfortunately, I think in the nervous market sentiment, along with those reasons, I think the fundamental aspects are also being questioned, and that's where I think we are seeing the larger part of the fall. I don't think that the fundamentals of the company weak. I think last 3 quarters they've been showing robust performance, and every commentary they've been saying that I think the company is, I think, well on track as far as I think the growth in the business is concerned. Might as well, I think, they start looking into their corporate governance practice. I think that may be a better approach, as I would like to put it across.
It's really a mysterious case of Sterlite Tech as to why investors have not yet got the confidence to come into the counter, despite the management commentary, despite the financials and the numbers that they keep posting. 12 months, the stock's down 71%. Deven, we come back and talk to you about a few other spaces, but I need to get in those top trading ideas from our technical experts now before we hit market opening. Let's start off with you first, Shubham. What is your top call for the day?
Deven, I would like to go with the IT space, and most of the stocks from the IT space are showing outperformance, and I think this sector will continue to do well. And within that space, HCL Tech looks quite promising, where there was a big up move and then a consolidation, and now the consolidation is mature for the next breakout. So HCL Tech is a buy for a target of 1120, and a stop loss can be maintained at 1050.
Okay. What about you, Srikant, Chouhan?
I would like to go with IRB Infra, because all these weak companies are falling heavily, and the previous lowest level for IRB Infra was around 65, 66. So there is huge scope for stock to fall from current levels. So it's a sale at current levels with a stop loss at 83.50, and we can expect minimum 75, maximum could be 65.
Minimum 75. That's about a 7% loss. 6.5% odd downtick that Shrikant sees. So, gentlemen, we'll just take in opening thoughts from all of you before we let you go. But here's how the markets are starting off today. Again in the red, down about 0.5%. The banks correcting 0.8% already. So, quite a deep gash, really, not quite in sync with what the rest of the Asian pack was doing. And the banks are clearly facing the selling brunt. 0.5% for the Nifty and the Sensex too. So the pain continues. The mid caps and the small cap industry should come up on your screen. And again, painful, about 0.5% for the mid cap space. The market breadth is not looking all that impressive. Get the heat map up on the screen. See which of the banks are correcting, because it's now down 1%. ICICI Bank 2.5%. Yes Bank another 1.5%. Indiabulls Housing 2.5%. Bajaj Finserv, SBI, Axis, HDFC is down about 1% as well. Banks are clearly taking it on the chin. I don't want to sound like a scare, trying to scare the living daylights out of people, but banks are certainly facing some pressure immediately on open, which is quite a worrying sign. The breadth is negative, save for Wipro, maybe Tata Motors, but that could be a freak move. We don't have too many gainers worth their salt writing about, and we are now trading at the lowest point of the day almost immediately. 245 on the Sensex, about 76 on the Nifty. It's looking like an ominous start, but watch out for the banking space. That is the one that is clearly putting the pressure. The Nifty is now down 0.75%, and the Bank Nifty is 355 points down on open itself. It is looking a very, very wobbly start. Devina, what are you spotting?
Well, starting off first with what we can expect in terms of losers. Obviously, the market breadth is extremely weak right now. We're almost 1:4 in favor of the declines. But with the losers, starting off with CG Power, again a 10% dip. That's lowest circuit for the counter. Indiabulls Real Estate yesterday session saw the entire real estate pack. In fact, in the last few days, real estate has been seeing the much, they were up until now holding out pretty okay. But I think the negativities got to the sector as well. So Oberoi Realty, DLF had its own issues yesterday. Sobha is the only one that's probably holding up in today's session. Then you've got the likes of Shrey Infra, small name, but it's around 5.5%. Deven Housing Finance continues to reel under pressure. You've got Jet Airways and lower circuit. DB Realty, again from the real estate pack, is down. Eros International, Lakshmi Vilas Bank. These are your usual names that you see amongst the losing list. Edelweiss is the other one that's down another 4%. And there are some news reports suggesting that there is an ED inquiry into Edelweiss ARC's investment into Kohinoor. So that is something that probably could be weighing down on the stock. But this is, newspaper reports. So the stock's at 101, could well go into double digits in today's session as well. But, far and few in terms of gainers. Den, Hathway, these are your usual gainers. Igarshi is up 5%. You've got Rajesh Exports up about 2.5%. Then Gru Finance, Coffee Day, these are the names that are up.
But banks, clearly the pressure point out here. Shubham, what do you do with the bank Nifty now? We spoke about your Nifty view at the start, but the banks have corrected another percent, 333 points lower. Are they near some kind of supports from where a bounce could come in? Would you play for that? Or conversely, could you take a short trade even now on the bank Nifty?
Neeraj, if you look at the banking index, it would buying here would be like catching a falling knife, which I would not recommend unless and until there is a price action which confirms this move. So for now, the bank Nifty, there's no clear trade out there. But if we have to take a short position for intraday, I would recommend SDFC Bank, because that is the bank which is actually pushing the bank Nifty lower. So SDFC Bank can be sold for a intraday perspective for a target of 2120, and the stop loss can be placed at 2170.
2120. Shrikant, what's the top banking short from your end?
I think there are like a number of stocks which are PSU banks, especially because they are breaking their previous lows. So Bank of Baroda looks top short at current levels, which is trading at 90.50, 60 something. Below 91, we are expecting stock to move towards the levels of 85. So it is again 5 to 7% sort of weakness that we can see in the stock. Currently it is at 90.5. So 93.5 should be the stop loss for the stock to go short, and we can expect 85 on the downside. We also bearish on HDFC Limited, because this one is the last stock which falls heavily whenever there is like a steep sell-off in the market and markets are heading towards major lows like 10,585, 600 was the yearly lowest level for the Nifty. So if we are moving towards those levels, that means something is really going wrong in the market right now. So all these large cap stocks are also falling because of that. So HDFC can fall down to some 1900, 1920 from current levels. So it's a short, even at this price, 1975, we can keep stop loss at 2010, and we can expect 1900 on the downside.
All right, interesting from a technical standpoint and from a fundamental standpoint, because Bank of America Merrill Lynch has actually reinstated a buy call on HDFC, and they put in a target price of 25.70 on the stock. But I guess Shrikant's call is more short-term in nature and from a trading perspective. But I'd like to thank both you gentlemen, Shubham as well as Shrikant, for joining us this morning. Let's also bring in Amit Khurana, Head of Equities and Research at Dolat Capital, who's joining us right now on the show. Amit, thanks very much for taking out the time, and very good morning to you. What are you doing in such a market environment?
Well, protect capital as much as you can, be less adventurous, and look out for safe havens. I mean, that's the stance we have taken. I mean, it's quite a terrible situation, and all the expectations of stimulus are getting negated. And I mean, what we're now looking at is a classic derating for the Indian equities. I guess we will probably continue to see the valuation premiums contracting over the next few months, because the outlook continues to be quite hazy and quite negative.
Amit, in light of that, would you believe that there is a high probability of the markets drifting lower another 4 or 5% or maybe even more from where we are right now?
Well, yes, I do firmly believe that over the next few months we will see a further derating. So while it's difficult to quantify 4-5%, whether it could be more than that, but definitely I think the trajectory seems to be on the downside, and I think it's all very evident from the worsening situation that we are seeing on the domestic side, on the consumption side, on the key sort of drivers of economy not showing the required traction, and therefore I also believe that the current earnings estimates which got cut after the first quarter earnings, they're now more closer to 16-17%. I think there's a real risk of that getting closer to a 10-12% number eventually, and that also will probably be driven more by the base effect rather than real earnings growth. So to that extent, I think there are downside risks to the markets at large, and that will play out over the next few months. So we're quite shall I say, I don't want to sound paranoid, but we're quite concerned as the way the current valuations are.
For autos as well, the last 2 or 3 sessions, while the markets have looked iffy, autos have held out. In today's session too, the auto stocks, large portion of them are trading in the green. Have they kind of hit rough valuations from where they could see buying?
Well, tactical buying here and there can happen. That can be driven by a few technical factors also, short covering also. But our take is that the auto space, I mean, let's split that up. I mean, you look at CVs, the cycle doesn't seem to be getting better. I mean, there's that hope which has been built into the market that the government will come in and probably give a stimulus package, and they will probably do a GST rate cut. The challenge is the headroom for the government to do a massive stimulus package is constrained by the commitment of the fiscal numbers. And GST rate cuts for one particular sector are not going to help beyond a level. I mean, they might give you a blip up for 3-4 months, but really the structural drivers of demand for CVs are at a serious risk. On the four-wheeler side, passenger cars in particular, I mean, Maruti we've liked at a certain, at this broader range. I don't think it will have a major downside risk from a valuation perspective, but the risk is on the regulatory environment becoming far more stringent over the next 3-4 quarters, and that will have its own ramifications on how the buyer behavior works out, on what kind of price hikes we get to see from the companies. And two-wheelers is probably the worst. I mean, we've been negative on two-wheelers for a long time. I don't see evidence of any recovery happening on that even in the next few months. The serious concern is that the kind of regulatory intervention, the kind of stringent norms that are being played out every 3, 4, 5 months, there's new regulation coming in, that has really impacted the ability of these players to really put out something in terms of volume growth estimates. And my sense is that this year will surely be a negative number on volume growth, but the risk is, does this become more structural in nature, wherein you have a muted volume growth estimate for next year? I think that's what the market is now beginning to sort of evaluate, and therefore the kind of concerns that you're seeing on the valuation downticks.
Do you think the festive season could be the silver lining this time, or no?
Well, the hopes are there, but I'm a slightly more realistic in my assessment. I think this festive season may not really work out as expected, and therefore this hope, sort of trade which has held on to the premium valuations for India equities will probably sort of go off. I think my sense is that in some of the sectors you might see Q2 actually worse off than Q1. And therefore, the bias that we have, that this 15-16% earnings growth is also at risk. So I'm not very sort of enthusiastic about this whole festival demand playing out and showing recovery in earnings and helping the valuations to sustain. I'm not as enthusiastic as the general consensus seems to be. And I would say that over the last few weeks, we've actually seen sort of a reality check also emanating, and that's exactly what is reflecting in the market behavior.
The reality is also that if you have incremental cash, you are going to look at investing. You don't want your money to be lying idle at this point, Amit. So if at all there are any pockets of opportunity, according to you, where incremental cash can be plowed in, where would those be?
Well, it would typically be IT services, I would say, because the rupee depreciation would help them. I mean, we're already beginning to see evidence of that. So in our estimates, there could be a potential 2 to 3% upgrades for next year. So IT services, I think, remains one of the preferred bets there. Having said that, I think some of the larger private banks will continue to do relatively better. So that could be another pocket to look out for at a larger level. Cement, we have had a positive stance. We haven't yet changed that. My essential backup on cement is that the utilization levels have sustained reasonably well, and with the raw material, the cost headwinds being much lower, they should be able to hold on to their EBITDA levels relatively better off. So these are some of the few sectors that we are backing up for. But having said that, ultimately the valuation premiums, as I said earlier in my comments, will continue to be quite constrained. I mean, we are not going to see the peak valuation premiums on any of these sectors that we saw over the last year and a half, couple of years. I think they will probably be marked lower even in the upcycle for these sectors.
All right, Amit, we'll leave it at that. Thank you so very much for joining us with your views this morning. And it looks like the indices, are holding on to those losses, 60 odd points down on the Nifty, but it's been a bad ride for Bank Nifty, now down about 357 points. Bringing in Chakri Lokapriya, Managing Director at TCG Asset Management. He's joining us on the show right now. Chakri, thanks very much for accommodating this very short notice request. I want to start off first with the deal that's happened within the consumption space now. Amazon is clearly extremely positive on the India story. I mean, even while we question consumption here, they're probably seeing something we're not. This is their third investment in physical retail here in India. What would you make out of it? Probably, the fact that if they're seeing something coming out of this, it should not be that bad, and probably even retail investors can start looking at nibbling into some of these even expensive consumption stocks.
Good morning and thanks for having me on the show. I think Amazon's entry into India, or rather expansion into India, is a function of they're buying up various building blocks which is necessary for them to compete effectively in any given country. And they have done that time and over again in different countries. And so from that perspective, yes, the acquisition clearly demonstrates an interest in India, but I wouldn't extrapolate saying that, and therefore it is time to buy, because they're buying enabling companies which will help them do their business better in India.
Okay. Okay, Chakri, good morning. Having said that, are you buying either enabling companies or other companies? You've largely been a bull on India the last few days because of the volatility surrounding the expectations of stimulus and dashing the hopes, and then reigniting those hopes have led to significant volatility. Now seems to be a clear downtrend. Are you buying here, or are you as bullish as you would be, preferring to sit on cash?
Good morning. As the budget approached, we were very bullish, but post-budget and the introduction of the FPI taxes, the taxes on AIFs, as well as a kind of a reluctance, or rather delay in responding to corporate requirements, is something which is deeply troubling for the market participants. I mean, look at various government companies, BHEL, SAIL, MTNL, all these companies are trading at decade lows or 15-year lows. And the last thing you would want is a government economic advisor telling corporate India how to run companies. Worldwide, central banks and governments and companies listen to companies' needs, because they are the drivers of growth. They are the creators of jobs. And here we have, and so when there is that lack of communication and lack of receptiveness, I think that has never been a good news for markets around the world, and it's manifesting itself in India. And so as long as there is no communication, or rather poor communication, I think these markets will drift lower.
I just may sound like a contrarian, but even if, for that matter, we do see a recovery from here without any stimulus, wouldn't that then be a more real recovery without any short-term shots in the arm, more sustainable recovery, because you've reached grassroots levels, and from there you've actually started to pick up on all variables without any external or stimulus support?
That's a good point, but one has to look back at what caused the economic downturn, or rather the slowdown. which is in many cases, for instance, power companies. They still have to, account receivables are pending from the government. Telecom industry, huge amount of debt because of a TRI's regulation saying mandating lowest tariffs in the world and highest spectrum prices. You look at media broadcasting companies. They have now the lowest broadcasting rates in the world. So that has led, or rather increased, the what you call the corporate stress, the balance sheet stress. And in any business, and that's the problem with Indian government too, when your revenue that is lesser than your expenses, then there is a problem. And then if you try to manage the situation by increasing taxes rather than increasing demand, then it's not such a great thing. I think that is what has happened. And then over and above that, further increase of taxes. Today, an FPI who comes into India, a very important source of capital, more than half of all capital which comes from FPI. And if you tax them at punitive tax rates, whereas advanced countries do not do that, then capital will flow elsewhere.
I take your point, but when you have, industry leaders, I'm talking from the auto space, you had Mr. R.C. Bhargava and a few other within the auto pack itself, which is suffering a whole lot, saying that the industry needs to look at its own shortcomings and we can't expect the government to sit and cut taxes for us. That probably lays it out for you.
Well, from that perspective, it was the government or government agencies which introduced insurance, 3 years insurance on companies. A buyer of an auto. When you buy a bike or a car, then you insure it for the first year. But why should one introduce and impose a 3-year insurance to be made upfront? Who introduced it? It's the government who did that. And then you look at the registration taxes, road registration taxes has gone up manifold, and now there's a proposal to hold it back. So when the rules of the games are changed, and the input tax credit, there is a huge amount of delay in the repayment of this. So all these are factors which are not caused by the industry, but rather these are the cogs in the system which has contributed to the current downturn.
Chakri, not being bullish is one thing, being bearish is quite another. Are you bearish?
Magically tomorrow, if we have some policy announcements or rather policy measures, the reversal of FPI taxes, we would be turning really bullish. On the absence of which, and it's been a month and a half, then I think there is no reason to change your stance, but to continue to be cautious.
So it's not an economic call, it's a tax-linked call, your bullishness or bearishness.
Tax is one of the most important things because tax reduces flows goes into companies, and that leads to private capex creation, which converts into jobs, which creates into income. So while the government is focused on just the tax issue, the chain of linkages in that of how important capital is. Now, I think it serves well for everybody to remember that equity is risk capital. Risk capital, therefore, is taxed at the lowest tax rate around the world. One cannot tax it at the same level of debt because debt is seemingly assured a fixed interest rate, if a fairly good credit allows a repayment of principal, whereas equity is risk capital, which is therefore taxed at a very, very low tax rate, including the developed economies. By taxing it at far higher rates, clearly then we're choking off an important source of contribution for creation of capital expenditures by companies.
All right, Chakri, great having you today and appreciate you taking out the time.
Thank you.
Thank you so much. All right, that was Chakri Lokapriya there with his views on the market. The index has slipped further, so now down 80 points on the Nifty and almost 400 points down for the Nifty Bank. So it looks like an encore of yesterday, at least the start of it looks like we could be doing the same. But we're going to slip into a very short break. In fact, even the currency has slipped more. But on the other side, we take a look at the road ahead for the Indian drug makers as competition intensifies in the profitable US market with Surjit Pal of Prabhudas Leeladhar. How bad is the hangover from consumption slowdown for liquor companies? We'll speak to Shekhar Ramurthy of United Breweries.